For most people who have kids still in school, summer has ended either last week or the week before. This is the end of Bowen's second week at Connect Community Charter School, the school that Burgess founded and we funded. We're the angel investors for it, and it's so great seeing 150 kids run around with Connect shirts thinking, we started that, we funded that, we created this dream of bringing emotional-based, project-based learning to not just kids whose parents can afford a $25,000 a year private school education, but to kids who, are underserved. So it's just great going there every day, dropping Bowen off and seeing 149 other kids run around with the Connect shirt on and just seeing that impact you can make. So though fall has not begun yet, if you look on the calendar, for most people emotionally the summer is over and fall has begun. And what I want to do this week is look at 3 charts. And I want to strip away news and opinions and headlines and just really get to what matters most with protecting money and growing money and investing money. And at the end, I want to share with you a great little story that I overheard. Now, before we get into that, my thought for this week is buy strategies, not stocks, and find yourself a good therapist. I actually have changed my therapist over the last 2 months, and it has been great. And I've already noticed a lot of shifts in myself and what's going on in my mind and my behavior. And if you want to grow your money well, if you want your money protected well, if you want to stop stressing about your investments, then you're going to want to buy strategies and not stocks. Own strategies that manage the whole process, and then that will allow you to put your attention back on your kids, your family, your husband, your wife, your community, your church, your synagogue, your temple, or earning more money. But this idea of putting more effort and time into investing is actually an idea that does not work, even though people really try to prove me wrong. It's very difficult, and only a handful, literally a handful of people on this planet are able to increase their effort on the area of growing money and actually have it improve. The other 99.99% of us, it's not going to work. So the question is, what are the 3 charts I want to look at, and what are they telling us? Great question to ask. So the first chart is the S&P 500, the most important stock index in the world, regardless of where you live. This index drives more stock prices, equity prices, capital gains or losses than any other index in the world. So on the screen here you see 2 lines. The bottom red line is the old lifetime high of the S&P 500, which was reached in 2007 and the year 2000. The red line on the top is the new lifetime high that was hit at the very beginning of August, and let's just call it 1700. So between those 2 lines, there's a bit of a, let's call it a battle. Let's be headline-like. And there's a battle going on between those 2 numbers, 1576 and 1710. And look, the S&P 500 knows about Syria, knows about Iran, knows about Israel, knows about Putin, knows about Obama, knows about the U.S. Congress. It knows more than any other entity on this planet knows, which doesn't mean it's perfect, but it has the best view of what's coming down. And so if you look at this, problems will not start to occur if the stock market sees it until the stock market breaks below that 1576, which is right here, which was the June low. And if the stock market sees good things ahead and Syria is going to resolve itself and all the money printing is great and it's whatever's going to happen with it, whether there's tapering or not, I personally think tapering will happen. And I think the stock market sees that it's going to happen. And I think it's potentially seeing that it's not going to impact it. If tapering will impact the stock market first has to break below this bottom red line at 1576. If it doesn't break below that, tapering will not affect the stock market like so many people believe. So let it not be effortful and difficult and complicated. Just watch the stock market in relationship to these two red lines and let it tell you what's going on. Now look, if the stock market breaks above 1710, that is incredibly bullish, and this thing can go up. Probably this next stop will want to be 1750 or 1800. And if it breaks below 1576 and Bernanke doesn't quickly run in and say, okay, I'll put the money printing back up to 85 billion. Okay, sorry, I'm a slave to the stock market index. Then, we could potentially start to have a real price discovery mechanism with the S&P 500. Because you've heard me say for quite a while, the S&P 500 is only going up, or 70% of the reason it's going up is because of money printing. Now, the next price chart I want to show you is the price of gold, and this is actually the price of gold, and I have two red lines on here. The bottom red line, if you look at that, is actually a very crazy number called 1357. And the gold hit 1357 in April, bottom at that, and then it bottomed at 1357 in May, and then it crashed through that number, came up here. And so really, to me, gold has to clearly break through 1357 and continue falling before I even want to pay attention to it or think anything much of it. Now, on the upside, we have a number up here, and let's call it 1540. And this number, $1,540 an ounce, was heavily defended until it wasn't, and it broke through it here in April of this year. But you can see here in May of 2012 and the very end of December in 2011, there was a strong resistance, and it actually created a nice support for gold at $1,540. But it crashed through again, and intraday it hit 1188 and then quickly moved back up to where it is today, which is above this red line. So as far as looking at some major breakpoints for gold, if you're worried about it falling, you don't need to pay attention to it until gold closes. I'm not saying it will, but if it doesn't close below 1357, then you have nothing to worry about if you want gold to go up. And gold really needs to break above 1540 to kind of have the second leg of it breaking out of this correction. Now, I think the bottom happened for gold. It happened on June 27th, 2 months ago, a little over 2 months ago. And so it will be kind of building a base. But that's what's going on with gold. Again, erasing the headlines, erasing the news, erasing the emotions, and simply looking at a price chart. This is what we have. One thing I do want to add, a lot of people say gold is connected to the value or the price of the US dollar, and I actually think that's a bunch of, garbage. The price of the US dollar has not changed. Now, it's moved up and down, but the price of the US dollar is at where it was at the beginning of 2005. What's that, 6 or 7 years ago? And during the exact same time period, even with gold correcting from $1,900 down to $1,200, now back up above $1,300, gold has gone up about 200% during the exact same time period where the US dollar is at the exact same price it was at the beginning of 2005. So this idea that it is connected to what the dollar does is kind of a bunch of crap. So that's gold. And then the third chart, which in some ways is maybe the most important for the overall global economy and people's investing, and certainly anyone over the age of 60, or I should say anyone who owns bonds thinking that is a conservative, safe investment, is this last chart I have for you, which is the 10-year Treasury yield. This is showing you what the yield is on the 10-year Treasury. And on here I have two lines and a red, really long rectangle. So the bottom line is what the 10-year Treasury yield had to break above to end its most recent downward trending direction. And it had to break above that 2.4%. And as you can see, it not only just broke through the 2.4%, it actually crushed through that and kept going up, had a little correction, and has broken up, which gets us to this horizontal line. This horizontal line is a downward trending line that starts way back in 2007, and the 10-year Treasury yield has hit it, pulled back, and now has broken above it. So that means that the sharper downtrend on the 10-year Treasury that started in 2007 has been broken this week, and that is very significant. And we're also at the 3% number for the 10-year Treasury. Now, interesting enough, 3% from a price chart point of view doesn't hold that much weight, but from an emotional point of view, we'll probably take a breather around here. Which leaves us the last place, which is kind of this area up here. I wanted to not just put a line, but have an area of where the 10-year Treasury, I think, wants to go next. And it's going to be anywhere between this 3.7%, oops, it's 3.7% right here, up to about 4%. That's the next place it wants to go. Now, if it just moves up here and then kind of consolidates between 3.5% and 4%, I don't think that's going to crush the housing market or have any negative effects on other areas of the market. I think a healthy 10-year Treasury right now between 3.5% and 4% is actually good for almost everything, except people who own bonds. I'm not being sarcastic about that, that's the truth. So really things will not get disorderly or really, really dangerous until the 10-year Treasury breaks above that 4%. But I don't see that happening this year unless things get really unstable. Now the main thing I want to point out with this price chart is anyone who owns bonds, anyone who's over the age of 60, whatever, 70, age doesn't actually matter, thinking that a conservative investment is bonds, I want to tell you that idea ended in July of 2012, which is this point right down here, which was the end of the 30-year bull market in treasuries. And so, in fact, I don't think people who are conservative, I don't mean politically, but investment-wise, want to actually own bonds because that is going to have a negative effect on their wealth and purchasing power over the next 30 years until 2042, so a long time from now. So people who own bonds, you really want to take to heart, what are you doing to protect your purchasing power? And my answer to you is get a strategy, not an asset class, not a sector, not a stock pick, or a bond pick in this case, but buy a strategy, get a strategy, follow a strategy that can protect your purchasing power and that can provide you cash flow for your investments for the next 30 years. I want to just finally end with kind of who benefits most from having me directly in their world. And I overheard a client talk to a friend of theirs kind of describing why they ended up working with me or someone like me or specifically me. And what he said to his friend was, you know, I did everything right. I went to college. In fact, I went to Stanford. And, you know, so I got the college degree. In fact, then I got a master's. And then then I got the wife. And then I got the kids. And then I got the house, right? And then I got the six-figure income. In fact, I got the $500,000 six-figure income. And then I tried the big box financial advisor and the independent financial advisor. And he kept going. I was like, look, I did everything the way I was supposed to do it. But there was this anxiety in me, especially as I was getting older, because I didn't see my net worth growing. And he's saying this to his friend, and I was actually pretty impressed that he was being open with him about, you know, the experience he was having with this money. He goes, look, my wealth wasn't growing, but I did everything I was supposed to do, and yet I was getting older and nothing wasn't working, and it wasn't about earning because I also had, you know, done that right. And he said there was just something missing and I was stuck until I met RC, and he showed me, he educated me, he taught me what the thing was, what that one thing was I was doing wrong that was kind of keeping me stuck to having to work, to never being able to escape my life of earnings. And so if that is you, and if you qualify, and I'm going to be sending something out in the very, very near future in the next week or two, if I just described you and the experience you're having, and if you qualify, then you may be able to work with me for free. And I'll describe how that would be so in an email that I'll be sending out in the next week or two. Until then, enjoy the rest of your weekend and your kids being back in school and in a regular schedule. And I'll talk to you guys actually this Tuesday with the monthly strategy gathering, going into the strategies and what is happening with the market and the internals that are breaking down with it and what we should do about that. You guys take care, and I'll speak to you then.